Joining us this morning, former Wells Fargo CEO Dick Kovacevich. Dick, it's great to have you back. We can't decide whether Fitch is trying to make out-of-the-box calls to stay interesting and relevant, or whether or not there are some serious concerns about loan growth and capital return requirements and so forth. What do you think?
Well, first of all, I don't think that any of the banks that failed recently failed because of lack of capital or too few regulations. They failed because the regulators, especially the Federal Reserve, just didn't do their job to cause the managements of these banks to reduce their risk, even though it was very visible. And in order to deflect their failure to act, what they have decided to do is to recommend that banks increase their capital and increase other regulations as if they were the problem. And I think that's what's impacting the banks, their stock prices today, and the concern about the financial community. It was bad policy, and it's not good for the economy. And it shouldn't. And I hope it's never implemented.
What do you think the solution is out of this? Is it paving a wider runway to more consolidation and M&A forward?
Well, that certainly is going to be what's going to happen. But the first thing that has to be determined, and which I don't understand, is why they think that the banks have got through all this who did not take excessive risk. They have plenty of capital. We need banks to support the economy and make loans. Why are you making these changes? And the reason they are is to try to deflect the blame that they didn't do their job. And Congress and other people have to step up and say, don't ruin our economy because of your failure. It's pretty simple. Now, there's some other issues relative to smaller banks and so on that do need to be implemented, but capital is not the issue. It's other issues that are smaller and less important in the scheme of things in order to keep the economy going so that banks can loan money to individuals and corporations who need it to grow.
That's sort of the question that I was going to ask. I know you have a problem with the regulators here, but as it relates to this warning, which CNBC is getting from Fitch, 70 bank potential downgrades, including the biggest and strongest, like a JP Morgan, what in effect will that do, first of all, to the banks and to their yields, and also to the idea that lending is already tight in this country? Will it make it worse?
It'll make it a lot worse, and it's going to increase the cost to the banks, and they're going to have to increase their margins and prices to reduce that capital. I mean, if pretty soon the maximum amount of return on equity that a bank's going to have is going to be less than 10%. Who's going to invest in financial institutions at a 10% ROE? It's just not going to happen. It makes no sense, and none of these failures had anything to do with too little capital and too little regulations.
Do you think the fact that there hasn't been much of a response beyond just calls for higher capital will make this situation worse in the banking sector? Because there are still issues with unrealized losses on the balance sheet. The Fed has been still raising rates as recently as July.
Well, yes, I said that there are issues, and there are issues anytime that you're in a difficult economy, which could go into a recession. It happens all the time. We get through these things. But what I'm saying is we don't need significant increases in things like capital and regulations. We need to maybe at the margin make other changes, which, we can go into, but I don't think they're important for us to talk about, and we should make those. But capital is, in my opinion, the banks are well capitalized, and evidence of that is we got through all of this, and only the banks that were clearly at risk have failed. Nobody else has.